You are listening to Keystone Stock Talk Show, episode 194. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. Great to be back with you now 1 week into an exciting new year. We are starting with a brief discussion of Canada's hot jobs report and Microsoft's investment in ChatGPT. It appears to be a good one. We'll let you know what we think in that regard. I will also answer a listener question in our Your Stock Our Take segment on K-Bro Linen, symbol KBL on the TSX, the largest owner and operator of laundry and linen processing facilities in Canada and a market leader for laundry and textile rental services in Scotland and northeast of England. The stock, which we have owned in the past and sold a significant profit for our clients, is on our monitor list in 2023. And a client asks if now is the time to buy. Brett, in our Your Stock Our Take segment, will also answer a viewer question on Intel, symbol INTC on the NASDAQ, the world's largest logic chip maker. Intel pays a relatively attractive dividend of 5% after the stock was cut roughly in half over the past year, leading to the question, is this company a value or a value trap? Brett has an answer for you. Will it be the right one? We'll find out. In our Finance 101 segment, Brennan answers a question that no one was asking. What is an FHSA? I'm kidding, of course. We received multiple questions on this new registered account, all from Brennan himself. The FSHA, or tax-free first home savings account, aims to give first-time home buyers, the ability to save $40,000 on tax-free basis towards the purchase of a first home in Canada. Brennan will have the details on this. I'm going to welcome my co-host, Aaron, and the Killer Bees, Brennan and Brett. How are you guys doing?
Doing well.
Gentlemen.
Yeah. Canada won the gold for the World Juniors. It was a great game.
True. Mm-hmm.
I know Ryan watched it. Did Brett, Aaron, did you guys watch the game?
I did not, no.
Come on. What kind of Canada spirit is that?
I'm busy.
The winning goal.
Research.
Well, as you guys know,
that stock recommendations.
Fair
Must
enough.
Be nice
as you guys know, in that
spend all your time watching TV.
As you guys know, the Canucks are a team that I follow. I hate them, but I follow them. And the winning goal in that game was scored by
you just like the Canucks when they win.
Draft pick,
right?
A draft pick.
So never.
Can you let me finish, for God's sakes? It was scored by a draft pick that the Canucks traded away to win now, and they suck now. But anyways, it was just like screwing it in a little farther.
Yep.
The Canucks are a nightmare. They are.
It's
but it was great to see Connor Bedard, which the Canucks should try to tank for, which they won't. And they'll end up in the murky middle, as per usual. But he was absolutely fabulous in the tournament. Could be a generational talent.
That's the nice meaty part of the curve, though, right in the middle, right? That's where you like to see
it's amazing, yeah. There's two things that are hard to do in hockey. Be right at the top and be right at the bottom. The Canucks can't do anything that's hard, so they stick in the middle. Very nice. Anyways, let's go on to let's talk the world of finance here. We have a couple items that were out, newsy items this past week. Canada's job report came in hot, and Microsoft's investment in ChatGPT appears to be working out, at least in the short term. Like we talked about in that segment, or the AI segment, probably going to be a hot sector this week, or this month. Could be this week too. Could be this year, is what I'm trying to say. But something to be wary of in terms of the latest TSX venture company that suddenly changes their name to XYZ AI. make sure there's a fundamental business behind that. But it certainly is going to be an interesting segment of the market to watch over the course of this year. Do we want to look at the jobs report first? Yeah?
Yeah.
I do. Okay,
Might as well.
so yeah,
Let's do it.
Do you have a summary of that, Aaron? Do you want to go through that for us? How the jobs came in? They came in hotter than expected in both Canada and the U.S. Where were the expectations, and where did they come in? And can you go over that for us briefly?
Who are you asking?
You.
Oh, okay. I don't know why
I'm
you're
pointing
asking
at
me.
you.
But anyways, okay. Yeah, so I don't have the specific figures right in front of me, but I think that the Canadian jobs came in at about 100,000 new jobs in Canada, which was
Correct.
blew way past expectations. I don't have the what the forecast was in front of me right now.
Brad,
But
do
I
you
think
have
that
those
what the
numbers?
most
Yes.
Okay.
Yeah.
Brad can go
yeah,
through
no,
those
I actually have
numbers.
that up. Yeah,
Sure.
so it was about 5,000 jobs expected versus 104,000. So to say the least, they appeared quite a bit higher, about 21
Yeah.
times higher.
For
And
sure.
it's when the government or the central bank, I should say, is trying to really pull down on inflation, when they're seeing these high numbers, normally this will put pressure on wage inflation, which is something they've been trying to draw back on. Unfortunately for workers, your wages are wanting to be suppressed by the central bank at this time to slow down inflation. And when they're seeing these high job increases month over month, they're going to have to pull back more, which right now it's wishy-washy. This isn't like an absolute thing when you see job growth that they're going to really push on the brakes some more. But it does lead to the expectation which they're going to stay the course or even increase interest rates just off this one data point. But overall, they're most likely just going to stay the course at what they are right now.
Yeah, I mean, I would say at least it would indicate more likely scenario that they're going to stay the course for longer, and it's going to be longer before we actually start to see interest rates come down a little bit. But I mean, that is the whole point, of course, of increasing interest rates is you want to put the brakes on the economy. And one sign that you're putting the brakes on an overheated economy is that it starts to impact the employment market, which is just way overheated right now, and one of the causes of inflation, but certainly not the only cause. So it was, but of course, this is just 1 month worth of data. So a lot of times, what we will see is that 1 month data is going to come in well beyond expectations, so more jobs than were expected, and we may end up giving those back in the next month or the month after that. But one thing that I found really interesting with the jobs report from a higher level view is just that in the US, jobs came in lighter than expected, in Canada heavier, and usually it's been the other way around, where the US market has been hotter than the Canadian market. So do you have the numbers on the US there, Brett?
I do in a second. I have to switch to that. They rose by 223,000, which was less than expected, but it wasn't like a substantial increase. It depends on the exact analyst. So it's slightly below. So I think they're expecting like 250,000, so 10% or something like that. So it's not like it's a massive change like we were with the Canadian one. Remember, we can use about 10 to 1 comparing the US to Canada. So when Canada's getting 100,000 jobs, you would expect if they're the same pace about 1 million in the US. So there's quite a big contrast, which is weird. Normally we're slow, like Aaron said. We're a bit weaker of economy generally when it comes to these sorts of things. You'll expect a big uptick in the US. They'll shoot up past us, and we'll stay out the course normally at a bit less of a lower rate, I should say.
Yeah, and of course in the US, they're optimistic about that jobs report because that indicates that maybe the Fed is not going to continue to raise if they start to see weakness in the job market. But ultimately, it comes down not to jobs; it comes down to inflation. Hot labor market will be a net positive in terms of increasing inflation. It will be a net increase to inflation, but it in and of itself, I don't think is what's going to move the hand of the Bank of Canada.
What I am getting out of this, though, is Aaron's prediction for the year is already wrong. He was stating that the U.S. was going to be the ones that they weren't going to cut less likely, and
no, I didn't say that. I said they were going to cut later than Canada. Canada was going to cut first,
and we're
because
seeing
they started
the
increasing a little later. Yeah, I mean, if this continues, then absolutely. But it is also just 1 month, so we don't want to extrapolate that out. If you just extrapolate that out, you end up doing what I did with my forecast just extrapolating the current trend, which is obviously just an absolutely horrid way to put together a forecast.
Already wrong one weekend. That's what I'm getting out of this.
So next week, cue the well-heeled economist going on BNN now and saying, all we need to quell inflation is more unemployment. So basically, somebody standing there saying, you know, I'm rich, and what we need is for more of you to become unemployed so we can slow down the inflation rate, which was all over Twitter in the U.S. over the course of last week. There were several, you know, well-heeled economists and financial spokespeople going on there saying that basically, and everybody's saying, oh, so you want, you know, the average public to lose their jobs so we can control inflation. Well, thank you very much.
That's
what,
a very populist thing to say, but it actually misses the point completely.
Well,
just being that, like, the whole point is that the market, the jobs market is, according to the stats, overheated right now. Like there's more jobs than there are people to fill them in most industries.
I guess the question is what types of jobs.
So the idea is not to, like, for people to necessarily lose their jobs, but essentially for these companies to maybe lose some of their business so that they don't have so many job openings. What do you think about that?
Don't say that out loud. I say don't say that out loud is what I'd say. Because no, I would say, like, there's also a question is where are the jobs coming from? Where were the numbers at this time last year, right? Like, I mean, we had, if you're comparing this time last year, we had Omicron, there was people out. I mean, they may have not, some people lost their jobs because of those scenarios, but, and where are we today? Like, how are they measuring full employment too is something that I would, you know, we could talk about that as well. And
absolutely. In terms of, like, what, like the whole methods of determining, like, what the employment rate is and all of that is up for debate completely.
Mm-hmm. For sure. All right. Well, let's get on to ChatGPT and Microsoft's investment there. Did you want to handle this one, Aaron, or should I give it to someone else?
Yeah, for sure. No. This was the one that I was supposed to handle, so this is the one I'll handle. Okay, good. So we've talked about ChatGPT in a couple of our segments before, and I talked about Microsoft. So ChatGPT, for anybody who's, I guess, essentially been living under a rock the last couple of weeks, this is what's called a large language model, essentially AI that can generate text, summarize text, have conversations with people that are very realistic. And it is a technology that was developed by a company called OpenAI. OpenAI was originally a not-for-profit company, and more recently they've modified their business model, I believe, to be more profit-centric. But in any case, ChatGPT was released to the public about a month ago, and it absolutely went viral. People were amazed at this technology's capabilities. As I said, you can ask it questions. It'll provide what appear to be amazing answers. You can use it for education. You can use it to write essays. So there's a lot of educational institutions. I believe in New York, just recently, they said that they were going to ban ChatGPT on any kind of school computing device because they're worried that students can basically just say, I would write me a book report on such and such a subject, and ChatGPT will write it. You know, certainly better than, you know, your average human could probably write it as well. So it's a major talking point right now in terms of what's going to happen, how this is going to change society. And also, you know, in some ways, people are maybe giving ChatGPT a little bit too much credit as well, which often tends to be the case. But we talked about how would one invest in this. We have received some emails and questions from clients about whether or not ChatGPT or this technology will displace Google as the dominant search engine. So that's something that is being discussed. You know, there's a long conversation that we can have there. My basic answer is that when in a world of disruptive technology changes, the way that technology changes so quickly, you can never say what's going to happen over the next 1 to 5 years. No company, no industry is necessarily safe. I don't believe that Google is under serious threat in any time in the near future from ChatGPT. And the reason for that is because Google also has some very powerful language models as well. Their main language model being BERT, which is not as powerful as GPT-3, but Google is a company with incredible resources and incredible talent. So they would not just lie down and allow their main business to be taken over. I will also say that the amount of data that Google processes through its indexes for search is absolutely massive. Chat or GPT-3 is not designed to handle that level of data the way that Google's indexes are. So there's a lot more cost, essentially. I mean, if you're a startup looking at using GPT-3 to create a search engine, the cost of that relative to Google, if it's going to be just a general search engine like Google has, would be astronomical. But this does not mean that it is not a threat. It is absolutely a threat to many professions, to many industries, to many business models. And it's also a major opportunity. But in terms of investing in it, OpenAI is a private company, so most people can't invest directly in it. But one way you can invest into GPT-3 and OpenAI and any of the future technologies that come from OpenAI likely is through Microsoft, because Microsoft is a company that has made a major investment into OpenAI, about $1 billion. And there's been articles out saying that, this may be one of the best investments that Microsoft has ever made, because OpenAI, essentially, I believe they have a valuation of, I think it's about $30 billion right now. And like in terms of how much Microsoft owns, the specifics of the investment that they made, part of it was cash, part of it was credits on their cloud platform. I don't have the information in terms of how much of OpenAI they own, or if it's really as simple as that. But one of the things that I think is really great about what Microsoft has done is that they are the preferred partner for OpenAI. And Microsoft, of course, is the second largest cloud computing platform in the world. They are essentially using they're integrating OpenAI's technology, GPT, into their cloud platform. I think that gives them a competitive advantage against the main competitors, which are Amazon's AWS and Google Cloud Platform. One of the things that Microsoft is developing, or has developed, although it's not released to the public yet, is something called Microsoft Designer, where essentially you can design images, not in the conventional way, but essentially just by putting in a text prompt, telling it what you want, and then it will create an image for you. So that has not been released to the public yet, but there's a lot of interesting things there. So the point here is that this is an amazing technology. I think that in some ways it is being overhyped a little bit. And I'll just give you an example of that. Particularly when you think of GPT as a search engine, it's not built necessarily to be a search engine. Doesn't mean that it can't do that, but it's I've heard it more accurately defined as like a massive autocomplete. So it's like when you're typing into your text message, and your iPhone or your Android can figure out what the word is you're trying to type before you type it. That's essentially what GPT is doing. It's trained on an absolutely massive data set. So if you feed it a prompt, it's basically predicting the text that would come after that. So if you say, write an article on ancient Greek philosophy, it's essentially predicting the text that would come after that. Quite a bit different than how a search engine works. But one thing that we really have to be aware of when we're using these types of language models is that they always want to give an answer, but the answer is not necessarily a good one. Most of the time, I think it is pretty good, but I've been looking at some YouTube videos where you have essentially like scientists, experts that are demonstrating GPT's performance if, say, you wanted the technology to write a piece of scientific research. And a lot of times it gets information completely wrong. And I had my own experience with this when I was using it. I asked it to provide me with a list of courses that I could look at to get better with GPT. And it provided a list of 10 courses with links, titles, and everything. And they looked absolutely fantastic. I was so excited to check out these courses, but I had to leave the house and do something. I was thinking the whole time, I'm really interested in looking at these courses to learn more about the technology. I get back, I take one of the links that it provided me, put it in the internet, and alas, this course did not exist. So it wanted to give me an answer, and it gave me an answer that looked very legitimate, but in fact, it really just made up the information. It completely falsified it. So if the information was there and part of its training data set, it would have likely given me the right information. But when the information was not there, it needed to give me an answer. So it just gave me something that looked good. And I think that if you're talking about using this technology for writing, fiction, creative content, no problem at all. But if you're talking about, scientific research or, things that are factual, you would need to verify that the information you're getting is in fact true, and not just part of its autocomplete. But amazing technology. And, one of the things that I'm looking at over the next year, and this is not in any way a prediction, this is really just a speculation, is that perhaps with this technology coming out to the market, it's technology that's easy for the average person to use, and it demonstrates the power of artificial intelligence very clearly to the average person. Well, this may rejuvenate interest in the technology sector, which was absolutely hammered in 2022. We've talked a lot about that. Nearly every technology company, almost every technology company down. The NASDAQ 100, which is technology heavy index, down about 33% for the year. Some great companies like the DocuSigns, the Zooms, they're down in like the 70 to 90% range. So it is possible that this new technology, and it's not just GPT, there's also text to image technology out there like Midjourney, like DALL-E 2, that can create like beautiful images just by writing in a text prompt of what you want. In terms of how this is going to be commercialized, I think that there's a lot of ways and there's a lot of speculation, but in terms of it just rejuvenating the public's interests in the topic, it may result in more people wanting to get back into technology stock, generally speaking, in 2023. That's not a prediction in any way. That's just a possibility, something to keep an eye on as we get further into the year.
Yeah, something funny that Brett ended up doing with one of these text to images was he put in an image of my face and then basically just wrote in, I believe from my understanding, Brennan monkey or something along those lines, and it made me look like a monkey. I mean, even though
I heard it just wrote in
image,
Brennan,
but
and that's
It
crazy.
was a real
Just-
picture.
just
I
you.
lied.
but that's something interesting. I know that like Aaron was saying with like Chat GPT, it's really good with fiction. I know that it ended up, there was somebody that used it to make a hypothetical or synthetic Steve Jobs interview with a big podcast individual as well, where it actually spit out a full script of an interview, which would have,
and it sounded like Steve Jobs as well. It was his voice.
Exactly.
And a lot of the stuff were things that I would imagine he would say, but we have to remember that is not Steve Jobs.
Of course.
Right? It can be making up. I just mean from a perspective of, you can't, it looks so real and it feels so real that I think the big risk is that it's going to trick a lot of people into thinking that it's infallible.
Yeah.
When in fact, it makes some pretty clear mistakes, and some of them are just factually wrong. And you can go online, if you look around, you can find examples of that. But still amazing, absolutely amazing technology.
Yeah,
for certain
very cool.
things. Yeah.
Excellent. Good summary. Now let's move on to look at our Your Stock, Our Take segment. I will take the first one. It's on K-Bro Linen Inc., symbol KBL on the TSX. Trades around 28.84. Stock is down 22% over the past year. The market cap, $310 million, pays a dividend 4.27%. What does the company do? They are the largest owner and operator of laundry and linen processing facilities in Canada, and a market leader for textile rental services in Scotland and the northeast of England. Now, let's look at in terms of the breakdown of segmented revenues for the 9 months of this year. In Canada, healthcare 74.3%, hospitality 9.2%. So the Canadian division in total of its total revenues over the 9 months, 83.5%. In the UK, healthcare is just 3%, hospitality is 13.5%. Total UK division is 16.5%. So primary businesses within the Canadian hospitality and healthcare market. Now, we're very familiar with K-Bro, having recommended the business way back in October of 2008 when Brennan was in kindergarten. and the shares were at $8.75. In 2011, while the company's shares traded at $22.56, we issued a sell rating, sell half near term, and later shifted their stock to a full sell in 2017 when the stock traded at $40. The reason for the rating shift at the time was the business was struggling to achieve its margin targets while it invested for growth. Since then, the stock has slowly declined. It's currently in the $28, $29 range. With the world reopening, the company's hospitality segment is finally back to pre-pandemic highs or levels. Let's look at in terms of the financials for Q3 of 2022. Consolidated revenues increased 19% to $73.63 million. EBITDA, though, decreased to $11 million from $11.6 in the same period last year. Net earnings were up to $2.5 million from $2.1 in the same period. The analyst estimates right now, well, if we can look at these for 2022, so at the end of this year, they're on a calendar year, 59 cents earnings per share. Year over year, that's down 27%. Its PE based on that would be around 47. Now, if we look into 2023, there's supposed to be a huge step up, 197% growth in EPS to $1.76. That would be a tremendous jump forward. By 2024, the estimate is for $2. Again, if we look to 2024 EPS, that would be trading around 14 times earnings, but right now it's 47. So if they leap forward, it can look good. Now, we have talked to management a number of times from our analysis on the company and our conversations with management. In the near term, particularly for next year, these estimates would be aggressive in our opinion. Earnings should take a significant uptick in 2023, but these estimates, as they so often are from the brokerage community, are just too positive in the near term. Our take here would be the business pays a solid dividend yield at 4.27%, but it is not cheap on an earnings basis and it remains leveraged. K-Bro can reach management's, if they can reach management's targeted adjusted EBITDA margin of around 18% while generating revenue of about $270 million, which is the estimate for 2023. The business would then trade at about 8 times EV to EBITDA. That is below its historic level, but it is, again, still not cheap on an earnings basis, an actual earnings basis. And it is just, it's not massively below. It's about a 10% haircut to where its average EV to EBITDA multiple has been over time. We anticipate the company to continue to pursue M&A activity over the next 12 months, continue to monitor its numbers for Q4 and into Q1 to see if management can begin to achieve those margin targets. K-Bro has significant recession resistance, which we like, that strong dividend yield, and the direction of earnings over the course of this year should be very positive. But given the tight labor market and high input costs, the margin recovery will likely be slower than analyst expectations right now. As such, we monitor K-Bro closely, but remain on the sidelines with its PE based on next year's earnings in the range of 21 to 25. It looks better going forward at about 14 times next year's earnings. We'd like to take advantage of maybe over the course of this year, if we see those estimates, which we believe are aggressive, if they're missed and the stock pulls back, it might be an opportunity to buy shares. Right now, we're just monitoring K-Bro. It's a good business. We'd like to see them, again, get back to the stated margin targets and produce higher EPS. We think that'll happen probably weighted towards the second half of this year and maybe into 2024. So there may be an opportunity at some point that we are monitoring in K-Bro over the course of this year.
Yeah, and it is a good business overall. If you look way back, they were much more healthcare and less hospitality, and they've gotten more into the hospitality business. But we've been following this company, Ryan, you and I, for years. We have seen them miss, their own targets quite frequently, I'd say, over the past 3-4 years. And of course, COVID was part of that because I think they just did a big hospitality acquisition in the UK.
Yeah, aggressive expansion for sure.
Yeah. So it was bad timing, but you can't fault them for that necessarily. They couldn't predict, the healthcare crisis. But it's, for myself, I want to see them get back on a growth track. That's what I'd be looking for. And as you said, even if they do hit those pretty decent targets
Aggressive,
that analysts
yeah.
have set out. Yeah, it's not extremely cheap even if they were
No.
to hit
Yeah.
those. They would need to exceed them for it to be what I would consider to be a very attractive valuation.
Yeah, I mean, if it gets down to 12, 14 times earnings and we have growth expectations going forward, because it's recession resilient, it's not completely over levered, and would probably have deleveraged by that point as well. Then it can be very attractive, especially if it's, in the same range, lower, paying a 4 or 5% dividend or higher. I mean, that would be a company that we'd look at. You can have a great company. Often it's not trading at very attractive entry price, or a long-term good investment based on the price it's at right now. We just like to see it a little cheaper, and then management start to achieve those margin targets. And I think, given the tight labor situation, I think it takes a little bit longer over the course of this year. Maybe we have an opportunity, as there's some aggressive targets for the start of this year. If they are missed, now those aren't targets from management; those are targets from analysts. So if they're missed, maybe the company takes a step back through no fault of its own in terms of its share price. Then we're able to buy what is a good company probably at a more reasonable price, and we get that more margin of safety in a business like this.
Yeah.
All right.
They also operate in Prince Albert, Saskatchewan, which is my hometown. So, that's a reason to buy right there.
You see those
Just
KBL
It's a
trucks
reason
driving down the
to
street.
run.
Yeah.
To run.
Yeah, to run. Yeah.
In Prince
Ryan
Albert,
from
they're
Yeah, in
operate?
Prince Albert. So they operate in Quebec City, Montreal, Toronto, Regina, Saskatoon, Prince Albert, Edmonton, Calgary, Vancouver, and Victoria. And then they also
that's
have some
funny because
operations
how
in
many
the UK.
people? What's the population of Prince Albert?
40,000.
7.
Yeah.
Yeah, because you compare
Yeah.
that's the only
I
city
know.
out of that group.
When I
It's
was
not
doing the
a major
analysis,
Canadian city.
that's what I thought when I saw it. I was like,
Yeah.
what? PA? But nah, I guess so.
There you go. It's
Yep.
a sign.
It's a sign. Head for the
Anyways, I
hills
thought I'd throw that
We
now.
love
Okay.
Prince Albert.
Yeah.
We do.
Yeah.
It's a
Me
great
too.
town. I've never been, but I've heard a
No.
lot
We've never
about it.
been,
Probably
but-
more than I need to.
Yeah, probably.
Yeah. Now, all right, let's move on. Brett will answer a viewer question on Intel, the world's largest logic chip maker, symbol INTC on the NASDAQ. Brett,
All
take it
right.
away.
Let's get right into it. Intel, symbol INTC on the Nasdaq, is the world's largest logic chip manufacturer. It designs and manufactures microprocessors for the global personal computer and data center markets. Intel is currently trading at $28.85 with a market cap of $123 billion. Intel is currently paying dividends for a yield of 5%. After the stock was roughly cut in half over the past year, it leads to the question, is this value or is it merely a value trap? The company did see a rough 2022, as seen in the share price, but its Q3 revenue fell by 20% year over year, and its non-GAAP EPS fell from $1.45 to only 59 cents. This can be attributed in part to weakening demand, which obviously they can't control completely across the entire computing market, but revenue for client computing was down 17%, and data and AI was down 27%. So quite significant for a company of this size. As well as costs climbed on top of that, leading to compressed margins from 58.3% in 2021 to only 45.9% in 2022 on a non-GAAP basis. The company is currently trading at a valuation of roughly 15 times its 2023 guided adjusted EPS. And that's a bit higher than the trailing non-GAAP. So if you Google it or on GAAP basis, you'll see about a 10 to 11% times, which this is just due to it being trailing and not looking forward. And we're seeing these lower numbers now, which causes a lower valuation when you're looking backwards. The overall computing market has fallen, but Intel has failed multiple times over the past few years. For example, the failure to get past 14 nanometer, which they have got past now, but that was probably the biggest stumble they've seen in decades. But more recently, we saw them just fall apart when they were trying to launch their dedicated GPU market. It was just, they couldn't launch it on time over and over again. They missed their mark again and again, and then it launched with severe technical complications, to say the least. So the 14 nanometer is now passed. They've moved past. They're on 10 nanometer now, and they're moving to 7 this year, hopefully, I should say. But during that time, it allowed their competitor AMD, who trades on the same symbol on the NASDAQ, to surpass them in many ways or trade blows in many other ways. Intel effectively just rolled out the red carpet for the red team of AMD during this time, and that failure seems to pause. They seem to be trading blows now again. So their 13th generation, which is their current generation, compared to their 10th and 11th generation during these past few years, the 10th and 11th generation of their consumer products were just horrible in price to performance comparison, which led to AMD taking a large percentage of their market share. It's roughly a 35-65 split right now. It depends on the exact metrics you're using, of course, and exact time frame. And this was from like a 10-90 split. So AMD took significant market share, but some of these leading metrics are starting to show that that's kind of plateauing off. But that's, like I said, these metrics are variable in the short term. So until I start to see these kind of stay that way for the long term, I would take it with a big grain of salt. But if Intel is able just to hold on to that 65-35 split, they should be able to grow in the long term as the overall market is growing still. Perhaps the most appealing part about Intel is its push into fabrication plants or fabs, which they have been always historically, but they've really started to push into it with a new plan. The company has received multiple subsidies from the US and Germany, as well as some other countries. If they are able to execute on these fabs and compete against the industry leader of TSMC, which is what AMD, NVIDIA, and a few other major competitors in the spaces currently produce on, they could see massive increases in revenue and, of course, earnings. TSMC, for just comparison's sake, is about 3 times the market cap of Intel at this time. But that is not to say there hasn't been problems already. There's been an article about from 2 weeks ago that Intel is now expecting delays in their Germany plant because they're looking for more subsidies, which they were expected to initially start construction for this plant in 2023 in the first half, but that seems to be pushed back later now as they're looking for more funding. If this becomes another 14 nanometer situation, the company could be in serious trouble if they start to just fund in this cash over and over for these fabs and they get delayed, which is what we saw with the 14 nanometer issue. And to the lesser extent, we could see that in the GPU, which they are keeping on for now. There were rumors for quite a while that they're just going to completely drop it or lower it, which they have lowered the exposure to it and their expectations for the market, but they haven't completely dropped it, at least at this time. The company is investing significant funds into these fabs, which leads to financial risk, of course. When you're putting large amounts of cash into these huge products, mind you, it leads to, can they keep up their dividend as well as their other operations? The current dividend yield is the highest it's ever been by quite a bit, is at 5%. I looked historically the highest before, which was in the mid 2010s. I think 2014, 2013, it was about 4%. But historically, it's been closer to 2.5%. So 5% yield is quite high, to say the least. The company's operating cash flow, which is what really drives dividend and sustainability, it dropped substantially over the year. So year to date, this is only up to Q3. They're reporting in about 2 weeks again. So we'll see some updated numbers and hopefully they'll look good for the shareholders. It's only 7.7 billion versus 24 billion from the previous year. So obviously that's a substantial drop, and this substantial drop hit their free cash flow, which is your operating cash flow minus your investments. So since they're investing in these large fabrication facilities, amongst other things, their free cash flow is expected to be negative for the year, running a deficit of 2 to 4 billion. If the company doesn't see an increase in operating cash flow, you'll likely see a cut in dividends, but for now, they can sustain it. But that if they don't increase their cash flow in the next 2 or 3 years, you most likely see some sort of a cut. The company has had some cash influx, though, because they spun off their segment of Mobile Eye, and they raised about 900 million for themselves, and they still own 94% of the company, meaning the company does have an easy divestiture to make if they need to raise capital on a short term. But at this time, they're saying they want to hold it, which makes sense. Management has as well stated that they want to keep dividend at the current rate, but what management wants and what they can do isn't always the same thing. So in summary, any potential investors need to take a long-term view for Intel, at very least 3 years, but more conservatively 5 years to see this fabrication plan take place, and as well be cautious that dividends might take a pause in growth or even a cut in the worst case scenario. And perhaps the most important risk to consider is the execution risk, as we've seen them stumble quite a few times in the last few years.
Well done.
Yeah, I mean, Intel's really been a perpetual performer in that space going back. I mean, I think, close to a decade here, or maybe beyond that. And one of the issues is they've always seemed to kind of miss out on a lot of these big trends. So they missed out on the smart computing trend. They missed out on the GPU trend, graphic processing unit trend for machine learning. And then they're always playing catch up. So they're a major player in the space. I mean, it's not that they're not generating solid revenue and generating profitability. That's not the point, but they always seem to be behind the innovation curve. And that allows their competitors to come in and pick up market share. So we check in on Intel all the time. Certainly, like you could define it as a value play in the technology space. But when technology stocks were, rocketing upwards, Intel wasn't doing that great. And now that technology stocks have come down, Intel's come down as well. So it's kind of one of those stories that, to me, it's been more of a value trap. I think that, if you look forward, there should be opportunities for them to grow, and the valuation is, not bad. Would you say about 15 times?
Yeah, 15 times.
I mean, that's okay. But, given the history of financial performance, just the history of the company, I think that there's probably better opportunities in the technology space out there. You'd have to pay a little more for them, but you're getting a more competitive company with better growth, in my opinion.
They did have a shift of pace last year. They did change CEOs, which is nice to see. Pat Geslinger, I think his name is, who he has a background in tech. He left the company, I think, for about a decade, and then he came back as the CEO. So if they're taking more of a tech way instead of just a pure finance way, I think that's a good thing for the company long term. Like, I agree with Aaron where it's been underperforming for years now. They fell behind. So I kept alluding to the 14 nanometer issue. They were stuck on 14 nanometer, which architecture size doesn't mean much these days. It's just a good gauge. But I will add that caveat that the numbers they quote are pretty meaningless today. But they were stuck on that platform for years and years. And they were stuck as well at 4 cores for consumer processors. And then that's what happened with AMD. They came in and they started to release these high core count products, 8, 12, and then 16. And they effectively removed Intel's Enthusiast lineup, which are these high core count products, which they did have, which not many people bought. And they pushed that out of the market. And those were very high margin products, which just got removed. They don't even make them anymore.
Yeah, so I mean, we'll wait and see. I know, like, in the chip space, there is a big trend to reshoring. So most chips are made in Asia right now. The dominant country is Taiwan, with Taiwan Semiconductors being the dominant company. And just for national security issues now, you don't want all your chips to be made overseas, right? So there's a lot of opportunity for them to pick up some market share in their foundry business. But I also think that there's other companies that, like AMD as well, that are trading at more reasonable valuations, even in NVIDIA, different story, but they just tend to be just more ahead of the curve in innovation than Intel.
Yeah. As far as just looking at the analyst estimates right now, if Intel does what analysts think it will do, then you may be buying at an opportune time now. Now, not over the course of this year, once again. Earnings are expected to be flat, basically on a per share basis over the course of this year. But jumping to 2024, you have like a 38%, then 2025, a 35%. That's what the consensus is right now. But again, as we've been watching, we could have almost had the conversation in terms of earnings the same 5 years ago. We would have said, maybe not this year for growth. A year out, they're promising tremendous growth at that point. If it came to fruition, the stock would have been trading at low valuations then. It's the same thing now. They have to execute, in terms of growing that market.
And the number, if you look at those numbers, the valuation on future estimates
would look great.
Certainly it doesn't look bad. It looks value, but it's looked value for 10 years.
Yeah, it has for quite a while, and the share prices come down because they haven't really driven per share earnings. If they can do it, like you'll look smart probably buying it 14 times. If a year from now, the next 2 years, they do 38 and 35% earnings compounded over those 2 years, you'll look very smart. But it hasn't come to fruition over the past 5-8 years, say, for example. So we'll continue to watch that. Now, Brennan, you want to answer that question that nobody was asking on tax tax-free first home savings accounts, the
Yes.
FHSA. Another an acronym that will confuse Canadians.
But
I'm
that
gonna put
matters to
everybody-
Brennan.
Yeah,
But not
Because
Brennan.
he could be a first-time home buyer.
Yeah,
so
maybe
Yes,
Brett
it
too.
is very relevant to you, and it's very, very relevant to a number of first-time home buyers. It's
Mhm.
actually a good segment, and I'm just bagging on you because it's fun.
Thanks.
Not
Thanks.
fun at all.
Well, yeah, I'll try
Love
not to
it.
put you guys to sleep, but honestly, looking at the work that I did here, it's kind of making me yawn a little bit. So the new tax.
What a way
free
to start a
first-
segment.
Yes, I know. I'm really engaging, getting everybody sucked into it. That's for sure. So yeah, the new tax-free first home savings account, or FHSA. So essentially, Trudeau's federal government moved to launch this new registered account, which aims to help first-time home buyers, such as myself, purchase a home in Canada. So the FHSA was first proposed in the federal budget of 2022, and on November 4th of 2022, the revised legislation was released as part of Bill C-32, and if passed, the FHSA rules will enter into force on April 1st of 2023, so not too far away. So how does the FHSA registered account work? So this new registered account will give prospective first-time home buyers the ability to save up to $40,000 on a tax-free basis towards the purchase of a first home in Canada. So like an RRSP, contributions to an FHSA will be tax deductible, but withdrawals to purchase a first home, including from any investment income or growth earned in the account, would be non-taxable, like a tax-free savings account, essentially. So we're kind of seeing characteristics of the RRSP as well as the TFSA here. So to open an FHSA, an individual must be a resident of Canada and must be a first-time home buyer, and they must be at least 18 years old. And the annual contribution amount is $8,000 and up to a $40,000 lifetime contribution limit. And like a TFSA, unused annual contribution can be carried forward. So if you contribute less than $8,000 in any given year, you can then contribute any unused amount in a future year, and in addition to your annual contribution limit of $8,000. So keep in mind, though, that carry forward amounts only start accumulating after an individual actually opens up an FHSA for the first time, which contrasts to the TFSA, as you do not actually need to open a TFSA for the carry forwards to begin accumulating. And an individual can keep their FHSA open for up to 15 years or until the end of the year when they turn 71 years old. So what kind of investments can you hold in an FHSA? Well, anything, just like a TFSA or RRSP, essentially, including mutual funds, publicly traded securities, government and corporate bonds, and GICs. And the question, when can you withdraw from an FHSA? So to withdraw, you must be a first-time home buyer at the time of withdrawal, and you must also have a written agreement to buy or build a qualifying home before October 1st of the year following the year of withdrawal, and you must intend to occupy that home as your principal place. So if the funds within the FHSA are not used, individuals are able to transfer funds from the FHSA to another FHSA or to an RRSP or a RIF, RRIF, all on a tax-free basis. So the one other thing that I wanted to include here to consider is the home buyer's plan, which allows first-time home buyers to withdraw up to $35,000 from an RRSP to buy a first home, will continue to be available, but you will not be permitted to make both an FHSA withdrawal as well as a home buyer plan withdrawal from your RRSP for the same home purchase. So it's one or the other, essentially. So to conclude, the newly proposed FHSA registered account has characteristics of both the RRSP and TFSA and should help Canadians like myself purchase their first home. And, I do think that it is interesting that you cannot use the RRSP's home buyer plan in unison with the FHSA account. But keep in mind, one could potentially transfer the funds from an RRSP to an FHSA on a tax-free basis, though. So you could do that if you wanted, which maybe I'll do. We'll see. I'm still in strategizing mode. But Anyways, do you guys have any comments on that? You guys are still with me? You're still awake?
Huh? Pardon?
Barely.
What? Sorry.
Yeah.
Keep us up to date, Brennan. Keep us up to date on your progress.
Yeah, we'll
That's
see.
great.
It might not even
I
be
think it's
this
great.
year. I'm being
No,
patient.
you can take us through that journey.
How are the
Be
markets
patient.
going out in
Well,
Saskatoon right
actually, Ryan told
tell us
me
about
that
the
I'm
index.
not. Yeah, I was just gonna say. Ryan said that I can't reference the index as a joke. He was obviously joking, but there is one
Was
home
I?
that is pretty close to me. It's pretty small, but it's kind of a turnkey, and it's got a double car garage, and it was listed at, I believe, $330,000. And just last week, it was reduced to $320,000. So
Ooh.
we're starting to see the market, turn a little bit here. But I'm still being patient. Who knows if 2023 will be the year for myself? But yeah, sitting back.
Do you guys even get a parking spot for that price in Vancouver?
Yeah.
A storage locker.
No, I don't think you
maybe.
could buy anything in Vancouver. I don't think you could even buy a condo in Vancouver for $330 right
Oh,
now.
no.
Even with, and I mean, I don't follow the market very closely, but I mean, I know that it has come down somewhat. I could be wrong there. But
Yeah. Not in Vancouver for sure, but you're saying even in like you got to look on the fringes of Greater Vancouver area, and I don't even think you'd get anything then for that price. But
yeah, maybe if you went into, I was thinking Vancouver proper, but
yeah,
Yep.
for sure. Okay, well, thank you, Brennan. Keep your questions coming in. That's going to end our show this week. Keep your questions coming into our Your Stock, Our Take segments. See if you want to debate an individual stock. Send that in if you want us to do that. And keep smashing the subscribe button on YouTube. If you're watching us on iTunes or wherever you get your podcast, rate and review us on iTunes. We really appreciate that. We'll continue to bring you good content over the course of 2023. Again, as always, I wish you profitable investing, and thank you.
all right. Thanks, everyone.
Thanks, everyone.
Thank you.